All right, so we still have some people joining us, but I want to make sure to respect everyone's time and, excuse me, get started with this great material. And it's a real pleasure to be presenting this workshop to you. It's actually a workshop created by Gary Keller, who is the founder of Keller Williams, the real estate brokerage that I work for. And Keller Williams is, in fact, the largest brokerage in the world by agent count and by volume of properties sold across the whole world. Gary Keller is a very, he's really a genius, actually. And he's phenomenal as both a business owner and a writer and an investor. And this book is based on his research of hundreds and thousands of investors across the US, and basically the models and strategies that they implemented to become millionaires through investing in real estate. And so, like he always says, and I do too, is you don't have to reinvent the wheel. These strategies and the models are already there. They've been proven over and over again. And all we really have to do is follow the signs and follow the well-worn path of becoming a millionaire through real estate. So that's why we're here today. So let's dive into it. So this is just a quick disclaimer. I'm not going to read it to you, but of course, this information is not guaranteed to make you a millionaire. We'll give you the information and then you have to decide what to do with it. So basically that's what this says. And just a little bit about me. I am, if you don't know me, I'm Carrie Gatto. And as I mentioned, I work with Keller Williams Realty based out of Cambridge, Mass. I've been a licensed realtor in the greater Boston area for over 10 years now. So I've seen a lot, a lot of different markets happening during that time. And I'm also an investor myself. So I have flip properties, I have wholesaled properties, and my favorite strategy is the buy and hold long-term strategy. And I own rental units in Massachusetts and in Maine. I did graduate from Boston College in 2001 with a bachelor's in psychology, and I went on to earn my master's degree in film production from Emerson College. I've been with Keller Williams for almost 6 years, and during that time, I've consistently been in the top 20% of agents there in terms of production. And I've served on the ALC, which is basically the board of directors for my office, for a little over 4 years. And I've been a productivity coach, meaning that I train other agents to build their businesses as well, which has been great. And like I said, I'm an investor myself. I'm a big believer in investing and helping others to do it as well. So again, this is the book that this whole presentation is based on. If you don't have it yet, I would definitely recommend getting it. It's a great resource, basically a manual for building wealth in real estate. So first, right off the bat, I'd love us to all just take a breath and think about what brought us here today. What has caused you to start thinking about investing in real estate. For a lot of people, it's financial freedom and all the things that go with that. So take a minute if you want to share. I'd love to hear in the chat what has brought you here today, what has caused you to think about becoming a millionaire or becoming wealthy through real estate. Feel free to put it out there so I can get to know my audience a little better. And for me, basically, it's obviously to share my thoughts on money, life, and investing in real estate. And I've actually written my own book about investing in real estate called You Can Have It All with Real Estate, and it is on Amazon. It's a really quick read, just an introductory book for people who are starting to think about real estate. And whether you've never bought before, never owned before, it's still a good kind of overview. And I truly believe that the more people who have financial freedom and financial security in their life, the more they can then give to others in their community and can follow their own dreams and their own passions in life, which I think ultimately makes it a better world for everyone. So that's why I'm here. I have a real passion for sharing this information with other people and encouraging them and inspiring them to follow their biggest goals, their biggest dreams, and build their biggest lives. Great. So some people are sharing. Let's see what we have here. So, hey, Matt. Matt says parents had a childhood home that was foreclosed on. Oh my gosh. Wow. And didn't ever want that to happen in my life. So that's a huge motivation, definitely. And Christina wants to be a smarter investor. Perfect. Alex says, I'm here for networking. I work for a self-directed IRA custodian. Interesting. And we help our clients hold real estate in their IRAs to grow tax-deferred or entirely tax-free. Well, that sounds awesome. We should connect, Alex. That sounds great. Thanks for being here. And Yvonne, hey Yvonne, she says, I can always learn something new. Absolutely. Me too. That's amazing. And I am definitely with you there. There's always more to learn regarding investing. And Alex says to start a legacy. Awesome. Awesome. I love it. Well, thanks again for being here, guys. And thanks for sharing. That's great. So what we're going to cover today are the possibilities, including the myth understandings, as Gary Keller calls them, of reasons that maybe people hesitate or don't invest in real estate at all. We'll cover the real estate investing statistics, and we'll talk a little bit more about your big why. We'll also talk about the power of leverage, which is a huge differentiator with real estate from other forms of investment, including, again, why real estate, why and how it's worked for so many people, growing your net worth, and then we'll talk about the proven systems. So what to buy and how to buy. So the possibilities. Well, financial wealth is the goal. And what that means is the unearned income to finance your life mission without having to work. So in other words, passive income. In other words, making your money work for you rather than working for your money, right? That's sort of the reason most people are here. And like I said, there are 8 myth understandings between you and that financial wealth. So let's take a look at those. The first 3 are, number 1, my job will take care of me and my financial wealth, so therefore I don't need to be an investor. And yet, in reality, you do need to be an investor. Your job is not your financial wealth. And why is that? Well, you've, of course, heard of people who spend more than they earn, right? And what tends to happen is as people's income increases, a lot of times they will spend more. Their lifestyle will increase as much as their income does. And so, and sad but true, a lot of people in America are spending more than they earn. So for that reason, and also because of inflation, your money that's sitting in the bank, if you're lucky enough to have extra money sitting in the bank, will not keep up with inflation. So if you're just saving and not investing, your money is losing value over time. So you need to invest for your future. And because you don't know what's going to happen, life happens, you need to make sure that you have investments for your own financial security and for your family. And number 2, I don't need or want to be financially wealthy. I'm happy with what I have. And that's great for now, for today. But again, you don't know what's going to happen in the future. So you need to open your eyes. You do need and want to be financially wealthy. I mean, even again, if you don't become financially free per se, at least having passive income can open up more opportunities for you. You can have more time off, for example, or if something comes up, like you need to take care of aging parents, you have the flexibility to do that. Or if someone in your family develops a disability, or God forbid you develop a disability, you are able to not be stressed about money while you're trying to recover. So there's so many reasons that you do need to build your financial wealth just in case. Or, you know, you're sending a child to college, or you want to go back to school, or you want to change careers. Another myth is it doesn't matter if I want or need it, I just can't do it. And of course, that's a limiting belief. The truth is you can't predict what you can or can't do until you try. And as I touched on before, you know, this is real estate's a very well proven path to financial freedom, and it's been shown that it's highly repeatable, and many people have done it before, and so can you. Okay, so 5 more investing myths. Investing is complicated. And if you don't know anything about it, it can seem complicated, it can seem overwhelming, and yet it's really only as complicated as you make it. And people in general have an inherent understanding of real estate. A lot of it's just common sense. And if you know a few rules of thumb and have a trusted team of advisors, you really, it's not that complicated. You can definitely do it. And then the next myth, understanding, is the best investments require knowledge that most people don't have. But again, the theme here, your best investments will always be in areas you can or already understand. And again, real estate is one of those things that most people kind of have a general understanding of. I mean, after all, everyone lives in a home, so it's pretty accessible and easy to learn about. Another myth is investing is risky. I'll lose my money. And that scares a lot of people. However, honestly, it's more risky not to invest, to be perfectly frank. And investing by definition is not risky. It's not a gamble. It's not a get rich quick scheme. It's something that you're going to, it's going to take time, but over the long term, real estate's always proven to be a good investment. And another myth is that successful investors are able to time the market. However, it's actually impossible to time the market. You can't do it. In successful investing, the timing finds you. And again, we're talking about the long haul here. We're not talking about getting wealthy tomorrow or even in a year. It's going to take 5, 10, 15, 20 years, but that's why you need to get started today. And lastly, all the good investments are taken. And I hear this a lot these days because prices are up and there's not a lot of inventory, and a lot of buyers are complaining about that. But every market has its share of good investments, whether it's a seller's market, a buyer's market. There are opportunities in every type of market. So if you identify with any of these, you know, let's try to move past these limiting beliefs and take action, because talking about timing the market, you've heard the phrase, the best time to plant a tree was 20 years ago, and the second best time is today. Same thing applies to real estate. The best time to invest would have been 20 years ago. We all should have invested 20 years ago, and yet the second best time is today, because your future self will thank you. All right, so here are some recent statistics pulled today, as a matter of fact, for the real estate market here in Massachusetts. And these are year to date. So they're all 2021 data, and they're also year over year. So these numbers are compared here to last year at the same time. And it's kind of interesting, but not too surprising. The number of listing units for single family in the first column are down over 12%. You know, we've all heard it's a tight market. And for condos, they're down over 25% from last year. So again, low inventory for condos. But for multifamilies, inventory is actually up almost 20% from last year. And so maybe that represents an opportunity for the multifamily buyer right now. for whatever reason, maybe the eviction moratorium, or coming to an end, or the fact that rents are down from, during the pandemic, rents took a hit. So that could be why the multifamily market has more inventory. And the single family and multifamily markets do tend to kind of be converse to each other, where, if single families become more affordable, most people do want to own a home, so they will opt to buy if they can rather than rent. So it does sort of make sense that they're the opposite of each other. And average listing price, the second row, is up for across the board. It's up over 13% for single families, and which is amazing year over year. That's unheard of. And also condos is up 15%, and for multifamilies up just over 6%. Average sale price for condos is, for single families, it's up almost 19% again, which is huge appreciation year over year, but driven a lot by the pandemic, because the inventory has been low, the interest rates have been so low, and people are just looking for the single family more than anything else. But condos are also up over 12% year over year, which is a healthy increase, because again, the average is around 5%, and multifamilies are up just over 9%. And I think interest rates, again, are a huge factor in those price increases, because affordability is high right now. People can afford to pay more, and the numbers still work. And for average days on market, it's a fast market across the board. So 63 days is the average for single family. And by the way, anything less than 6 months is considered a seller's market. And anything 6 months is considered balanced, and anything over 6 months is considered a buyer's market. It's been a long time since we've been in a buyer's market here in Massachusetts. 10 years ago, when I first got my license, it was a buyer's market back in 2010. And then since about 2012, it's steadily, the market has steadily increased in average value, and it's been a seller's market since 2012. So across the board, so condos, 73 days on market is the average, and for multifamilies, about 60. So what that means for buyers is that it is pretty competitive, although we've started to see just in the past couple months over the summer where it's become less competitive and a little bit slower, not quite as many bidding wars, and the inventory is starting to pick up, and also the days on market is starting to increase. So maybe that's just an effect of summer and people focusing more on traveling and making up for lost time, enjoying themselves, getting out there in the world. It'd be interesting to see what happens in the first couple weeks of September, if that trend continues or if it gets back to a more fast-paced market. We'll see. But that's where we are right now. So it's still a great time to be a buyer because the interest rates are still low. We don't know how long that will last, but you definitely don't want to be looking back at this time and saying, I wish I'd bought when, I could have locked in that low interest rate for 30 years. All right, so if you have any questions, let me know in the chat, and I will have time for questions at the end as well. So let's move on. So let's discover your big why. Your big why is super important. He preaches about thinking big. He's one of the biggest thinkers I've ever come across, and he's a very inspiring person. And it's important to think big. It's important because you only have one life, and why not just create the biggest life that you can and go for your biggest goals? And I think that everyone should. And so if financial freedom is your big why, then think about what you will do when you achieve that. Envision what your life will look like when you don't have to work. What will your daily life look like? What will you do when you wake up? Will you still work? Maybe you will, but it will be because you want to. Maybe you'll write a book or start a new business or pursue whatever is your passion. And then once you've identified your big why, you want to set big goals that are specific targets that will support your big why. So again, if financial freedom is your big why, then what do you need to cover your monthly expenses, your monthly nut? Is it $1,000, $5,000, $10,000? What is that number for you? And then work backwards from that, and what will it take as far as building a portfolio to generate that kind of passive income for you? Will it be 5 properties, 10 properties, 15 properties, 20 properties? And then how long do you wish for it to take for you to get there? So are we talking about a 5-year goal, a 10-year goal, a 20-year plan? Whatever it is, create those goals so you have specific and measurable targets to work towards. And then the big models are the proven systems and strategies for reaching your big goals. And in the book, the Millionaire Real Estate Investor, the 5 models are your net worth model, which is a 3-part model for identifying the best investment vehicles for your goals, budgeting your money in order to have more to invest, and tracking your assets and liabilities to measure your progress toward financial wealth. And then you have your financial model, which is a model for understanding the 3 ways wealth is built through real estate ownership: cash flow, appreciation, and debt pay down. Your network model, which is how you build and organize your network of investing relationships to mentor, advise, and help you. And number 4 is your lead generation model for determining your real estate investing criteria and then systematically prospecting and marketing for opportunities that match them. And then lastly, your acquisition model for creating terms that will minimize your risk and maximize your profits when making real estate investment deals. And then lastly, your big habits are the consistent actions and right choices that come from following your big models. We all know that habits are hard to break, so you really want to make sure that you're forming the right habits from the beginning, so that over time, the cumulative effect of doing those things day after day after day will yield exponential results. So again, don't recreate the wheel. Make sure that you're doing the things that have shown to create success. All right, so the power of leverage. There are unique propositions of investing in real estate that are unique to real estate and you don't see in stocks, mutual funds, and money markets. Real property is an able investment. Its value never goes to zero. Land has inherent value. And also purchasing real property can be leveraged, which just means that it can be financed. You can get a mortgage on it, whereas you can't do that with stocks, mutual funds, and money markets. So these are the reasons that investors love real estate. And what Gary means by a most able investment. It's accessible. Anyone can buy it because there are plenty of low and no down payment options available. There are plenty of ways to finance real estate, from conventional banks and loans to private lenders to even owner financing. And it's fairly easy to understand and easy to find. It's appreciable. It increases in value over time. And again, that's over the long term. Of course, there are market cycles, but if you can last through the cycles, then your pretty much guaranteed, if you buy right and hold it long term, that the value of your property will increase over time. And of course, it's rentable, which means that you have the opportunity for cash flow, which just means that it's a leftover profit after you pay all your expenses and allows you to make passive income, make money while you're sleeping. And fourthly, it's improvable. So you have the opportunity to create sweat equity, whether that's by doing work yourself or by hiring out. It's the same thing. You can add value to a property because it's made of wood and plaster and concrete. So it's something you can improve. And the government wants you to own property, and there are three primary reasons that make it beneficial tax-wise, and those are that it's deductible, depreciable, and deferrable. So it talks more about it in the book, but basically you can deduct any expenses toward the property, any improvements or maintenance or repairs that you put into the property, you can deduct from your taxes. And also it's depreciable, meaning that the IRS assumes that the value of your home depreciates over time through normal wear and tear. And so you can actually use that as a deduction as well. And it's deferrable, so that either through a 1031 or by purchasing money through an IRA, such as Alex here was mentioning in the chat, you can actually defer taxes to a more favorable time, and to an investor later. Paying taxes later is always better than paying taxes now. So you can make that work to your advantage. And number 6, it's stable. It's slow to rise and slow to fall most of the time. Many of us remember the housing crash from 2007, but that was a pretty unique circumstance that came about because of a lot of bad mortgages that were written. But most of the time, real estate values are not shocking or surprising. They are pretty stable. If you look at a graph of real estate values, it's usually looking like rolling hills over the years, whereas if you look at graphs of stocks, it's like this. It's like very spiky. So they're much more stable than most other investments. And lastly, it's livable. It's shelter in more ways than one, and that's just not being cute. I mean, you can actually, if you need to, move into one of the investment properties that you own. You could also house hack and live in one unit and rent out another, and have the tenant pay for your expenses in your mortgage so that you're living for free. So that's a nice way to think about it too, is you have to live somewhere. Why not make your home an investment? Okay, so this table is to further explain the power of leverage in a more specific way. So let's just look at this. Sorry, I'm moving my screen around so I can see these numbers. Okay. So, I'm sorry. A little logistical technical difficulty here. Too many boxes. Back it up. There we go. Okay. So the power of leverage. So if you're comparing, say you want to invest in stocks, mutual funds, money market, or real estate, and you want to make an investment of $100,000. Well, if you're going to buy $100,000 of stocks, you need $100,000. It's a 1-to-1 ratio. And the same goes for mutual funds and for the money market account too. Whereas right off the bat, you can see the difference with investment property. The cost of buying $100,000 worth of real estate is $25,000 because you only have to put 25% down and you can finance the rest. Or if you're living in the property and say doing a house hack, you could even put less down. But let's just stick with the 25K for now as an example. And then looking at carrying costs. So for stocks and mutual funds, you might be looking at like 1 to 4% for carrying costs, paying out in fees. And with an investment property, yes, of course, you have carrying costs. You have the mortgage, you have, maybe water and sewer, insurance, taxes. Okay, those are the basic ones. And yet, all those expenses, including mortgage, should be offset by your rent. So if you're buy right, you should have that, and you should have a cash flow. Other costs, basically nothing for stocks, mutual funds, and money market. For investment property, you want to factor in 10% vacancy and maintenance. But again, those should also be factored in and covered by the rent. So it should be paid by the tenant, ultimately not by you. And then your income per year. So for stocks, an average would be maybe 8% per year. And for mutual funds, maybe 10%. Money market is lower yield, so 2% might be a good estimate. And for investment property, a conservative number would be 5% appreciation year over year. But then we look at other income, right? So stocks, mutual funds, and money market, that's it. You don't get any other income. It's just the dividends that we see above. But for investment property, you of course have rent. So again, if you buy right, you should have all your expenses covered and then get a positive cash flow. So that makes up your other income. And then and we don't have a number here, but that depends on the property. It could be $100 per month. It could be $1,000 per month. It just all depends on what you buy, how much you pay, and what your terms look like. And then your adjusted return on investment. So for stocks, 4 to 7%, mutual funds, 6 to 9%, money market, just 2%. It's low risk, low reward. But for investment property, 20%. And that's, as you can see down below, calculated on 5% of $100,000 recalculated for the actual $25,000 investment. So because you only put $25,000 down, that 5% appreciation is actually giving you a 20% return on your investment. And that's not even taking into account the rent, because we don't have a number for that here in this table. So the rent would be additional return for your investment. And then lastly, potential loss. Stocks could go to zero, and so could mutual funds, as we saw in the Great Depression, for example. So there is the potential for those kinds of investments to go to zero. The money market, again, low risk, low reward, so there's not too much potential loss there. And for investment properties, they could go down. In the crash, there were some properties that went down as much as 40%, but they wouldn't go to zero. There'd always be some inherent value. So leverage, again, means using other people's money, banks, mortgage companies, or owner financiers to make money. So leverage can multiply your profit. Appreciation and rent are based on the total value of the property. So return on investment is calculated by money invested, so 25% or $25,000 in this example. And here's a calculation not taking rent into consideration, assuming your property went up 5%. And if you stick to your model and buying, that is conservative. So 5% of $100,000 equals $5,000 appreciation, and $5,000 is 20% of your $25,000 investment. So to make the same money in a mutual fund yielding 10% with no costs, you would need to have $250,000 cash. So I don't have that lying around. I don't know about you, but I could scrape together $25,000. All right, so let's talk about the money matrix. This is a model that is in the book. And basically, this is going to help us think about the mindset of a consumer versus the mindset of an investor. So on top, the top pyramid here is showing you how an investor thinks about money. And on the bottom is showing you how a consumer thinks and behaves with money. So in the top blue pyramid, your money is going to work for you, whereas on the bottom, unfortunately, you work for the money. So the first thing an investor does when they receive income is put some aside for capital. And if they're getting cash flow from investments they already have, they would put that right back into their investment, the lion's share anyways. So they're not spending first, they're investing or saving first. And then they, from there, will take the leftover and use that for spending money and consumption. So consumption is basically things that don't have any return on the investment, whereas the capital are things that grow in value over time. Now, in contrast, the consumer will consume first. So when they get money, their first action is to spend as much as they can and outlay cash. Then they'll think about trying to invest whatever is left over, which usually isn't very much. So that gives you the big hat, no cattle kind of dynamic, where you might appear to have more money because you're spending on things like cars or clothes or fancy gadgets. So it looks like you have a lot of money, whereas you really don't, because your capital is your last priority. So there's not a lot of wealth there. And as you can see, this kind of behavior leads to an unstable upside down triangle. So like if the winds change and all of a sudden your income fluctuates or you get laid off, or there's a big unexpected expense that comes up, the whole thing can crumble down. Whereas an investor has a solid base of capital that is going to continue to grow, because again, that cash flow will become, if you feed it back into your investments, into your capital, it will become a machine, a wealth generating machine. So think about yourself and your spending habits. Are you more of a consumer or are you more of an investor? And if you're more of a consumer, how can you set up models to streamline your money better so that you are setting aside money first for yourself, for your own wealth, and you're building your own capital and your net worth before you spend money? Because this habit is one of the best habits investors can have to build wealth. And again, once you start doing this on a consistent basis, it will grow your wealth for you, and your money will work for you over time. Okay, so now this is the financial model, part one, equity buildup. So when you buy a property, what you want to do, if you can, is to buy it with some built-in equity. So you're buying at a certain percentage below market value. And so that's what it means by buy it right. You want to make sure that you have some equity already there. And there are several strategies for doing this, which we can talk about. And then what happens is over time, your equity builds up, and that is in two different ways. That's because the market value obviously will appreciate, but also because your debt is getting paid down. And if you're renting out your property, your debt's getting paid down by your tenants, which is like kind of magical. So over the years, the debt starts to shrink down, your equity builds up, and your market value builds up. So at some point, you'll have actually paid off your debt altogether, and then you'll have a pretty dramatic increase in equity. So it's just a real simplified version of how that works over time. So yeah, so not only are you getting the cash flow from the rental income, but you're also getting this kind of forced savings plan of your equity buildup, so that at some point you could either sell and you'd have like all this equity, which is kind of like savings that you've built up over the years just from your tenants paying down your debt and from the market value increasing, or you could refinance and you could pull out money from that property and use it as a down payment for another property. So it's another form of leverage. So the financial model part 2 is cash flow growth. Again, you need to buy it right from the get-go. And what happens with rent over time, it goes up almost as fast as the value of the home goes up. So that your cash flow should also increase over time as the market value of the rent increases. And again, at some point, you'll have paid off your debt service, or your tenants will have paid it off for you. So you'll see that dramatic increase in cash flow at that point as well. And what you are going to want to do ideally is to use most, if not all, of your cash flow to roll it back into the debt. So you will just exponentially increase the pace of your equity buildup that way, and your debt service will get paid off quicker, and you'll see the pay it off come before you even need to, and you'll have that increased cash flow at that point. So this is 2 reasons of financial models why buy and hold long term is such a powerful strategy for investing. So to review, why do people invest in real estate? Well, return on investment, less out of pocket for more into pocket, as we saw with the leverage. You've got your tax write-offs, and you grow net worth through equity. You can also use this as a way to save for college. As they say, you can save for college for 25 cents on the dollar, right? So that could be your 10 or 20-year college savings plan, and many more reasons. So there is actually no better method of investing your money. Some tax write-offs here, some examples that you might want to be aware of, but as it says, definitely consult with a CPA or your tax specialist prior to investing, and ideally choose someone who's familiar with the real estate tax write-offs and who works with other investors of real estate. You have your operating expenses, management, leasing, etc. You have your mortgage interest. You might have financing costs like points paid on the loan, and miscellaneous closing costs, so fees are connected with obtaining the loan. Depreciation, as we talked about before, the structural value of the property is assumed to depreciate over time, even though it actually appreciates. And then you have your capital improvements, such as a new roof, siding, whatever. Your personal property, furniture, lawnmower, etc. If it's a furnished unit, that would be considered a write-off. And your maintenance expenses, toilets, paint, yard care, whatever it might be. You want to keep track of those. Okay, so as far as the systems of actually finding a property, one of the first things you need to do is figure out the type of property that you want to buy. And you're also going to want to figure out the location and, of course, your budget for the property that you want to buy. So those are 3 of the first criteria that you'll want to think about. So as far as types of properties, you could consider a condominium, a single family, or a multifamily, maybe a duplex, 3-family, or 4-plex, or of course you can go like for a huge apartment building. And And so with condominiums, one of the benefits would be that you might be able to get it at a lower price than a home in the area. You have an HOA usually with a condominium, which will have a monthly fee. But the benefit of that is that the maintenance is included in the fee. So any common maintenance for the building, for the shared areas would be included in that. And you might have more amenities, which could attract a great tenant. And then the cons, high HOA fees, just want to make sure you factor that into your monthly expenses, could mean less cash flow. And you only own a percentage of the land, although that does also mean shared liabilities. So there's pros and cons. And typically less appreciation, but also that kind of depends, appreciation depends too on where you are in the market, whether you're on the low end or the high end. Typically high-end properties will appreciate more, but you'll have a smaller buyer pool for the high-end properties. So it might take longer to sell, meaning that your investment is less liquid. And in a down market, it could mean that if the market turns into more of a buyer's market, the top of the market, the high-end properties typically feel that first. So it could mean a little bit of a softening of the top of the market. So in general, particularly for first-time investors, we recommend looking at the mid-range or low end of the mid-range of the market, because you have more affordability. So you have more renters that can afford it, and also more buyers that can afford it if and when you need to sell. And the value should be pretty stable because you have that larger buyer pool. You might want to avoid like the low end of the market, because you can have more issues with tenants, and also it doesn't appreciate as much as quickly. So that sweet spot is usually the lower end of the mid-market in any given area. Okay, and then you have a single family home, which a lot of investors love investing in single family homes. They're typically the easiest to resell because, again, most people want to own a home, so there's always high demand for single family homes, especially in that kind of mid-range budget. And you're typically going to be surrounded by owner occupants, meaning that the homes will be better cared for than if they were tenant occupied. The neighborhoods should be, nicer in general, and more appreciation. Again, because there's always demand and the population's always growing and people want to own homes. Cons, well, there's only one unit rather than like a multifamily to generate income. So if you have a vacancy, it's 100% loss if and when it's vacant. If you go the duplex route or multifamily route, 2 or more units, you might, obviously have to pay more depending on the market that you're in, but you're typically, with a duplex anyway, probably close to or in a single family neighborhood, which is more desirable because, again, owner occupants tend to take better care of their properties than absentee landlords or tenants. Maybe less risk than a fourplex, and also I would say more cash flow and less risk than a single family home, because you're not looking at 100% vacancy if one tenant moves out. Cons, possibly lower appreciation than a single family home, and it could be surrounded by other rental units. That's really neighborhood dependent. And then if you're looking at bigger multifamilies, 3, 4 or more units, obviously that could be potential for higher cash flow, and you're minimizing your financial impact from a vacancy. Economies of scale. So, instead of having a handyman come by and look at one unit here and one unit over there, you can have him come and address any repairs needed in all 4 units. But you have perhaps more more tenant turnover, so that will mean more wear and tear, more upkeep, and potentially less appreciation. Although, I mean, over the long term, I think the thing about multifamilies is they're really not making any more of them, at least in our market in greater Boston or Massachusetts area. You don't see a lot of developers building multifamilies. So I think the appreciation is definitely there, although, at least in the past year, single families have definitely appreciated more than multifamilies. And of course, you have more tenants, you might have potential for more tenant conflicts. So you might be more inclined to have a property manager once you get into this type of property. And so, how to buy? Well, you need to know the market. You need to get really familiar with the market, and that entails zeroing in and focusing your search. So, knowing your budget is going to be one of the first things that shows you where you're going to be searching for properties. Will you buy in the greater Boston area, or will you look in a less costly area, a different state perhaps? And from there, really find a market and focus in on it, and then get really familiar with the values there, so that when you come across an opportunity, it's a good deal. And from there, what you're looking for is a motivated seller, someone who definitely needs to sell for whatever reason that is. And if you can, of course, find them before they go on the market or the minute they hit the market, so that you're in less competition with other buyers. And make a strong offer, negotiate as much as you can, and make sure, you have to be very decisive, especially in a fast market like we're in now. So you have to be really ready to strike when you find that opportunity. Now with mortgages, there's definitely some options there, 30-year versus 15-year. And a lot of people nowadays with the low interest rates are just going for the 30-year because it makes sense, the money being so cheap to borrow. But of course, with a 15-year, the benefit there is that you get your debt paid off quicker, although your cash flow will probably be less, right, for the period that you have the mortgage. Do you want to put 25% down or more or less? So again, with an owner-occupant situation, or the house hack, as we like to call it, you could put down less than 25%. And of course, you have the option to put down more. But again, with interest rates being as low as they are, most investors are not choosing to do that. They're choosing to finance as much as they can because it just makes sense. Qualifying issues. So since the crash in 2007, and since the pandemic, actually just in the last 18 months, mortgage companies have become a lot stricter, and regulations have become stricter, and they've also become more risk averse since the pandemic. So you're going to find most likely that qualifying involves a lot of hurdles. You're going to have to do a lot of paperwork and show a lot of documentation. So it really is wise to get in touch with a mortgage broker sooner rather than later and start the process and see if there's anything you can do on your end to either improve your credit, if you can, which will in turn improve your rate or improve your, just your standing as a borrower, so that you can get the best possible interest rate on your loan and avoid any issues and make the whole process as smooth as possible. So I would definitely recommend getting in touch with a mortgage broker if you haven't already. And I can recommend some here locally who really know our market and know what it takes to make sure that you get the property that you want when you find it. And building your team, not only your mortgage broker, but also your contractor, your CPA, your realtor, your attorney, property manager, as well as other investors, mentors, and advisors, is going to help you so much. So I can't really emphasize that enough, that you want to start doing that right away. So question of property management versus self-management, I think typically when you're just starting out, you tend to default to self-managing. If you only have one or two units, that can be perfectly fine. But as you grow your portfolio, I definitely recommend aligning with a great property manager, because typically what the reason people invest is not to gain another job, it is to have the passive income. So especially if you have a career or a job of your own, you want to make sure that you have an excellent property manager to take care of all the kind of nitty gritty stuff, and you're not getting calls in the middle of the night. And so again, I have referrals for that too, if you're interested. And most property managers will offer kind of a scale of different services. So you can opt for, the lowest option of service where they're just doing the basics up to like completely 100% full service and you don't have to do a thing. So you just receive checks. Of course, that costs more, but again, you have to look at the risk or the cost versus the benefit. So if it allows you, someone else, the stuff and how much you can invest in and grow your portfolio quicker, then it, might be worth it. So next steps, I would say definitely read the Millionaire Real Estate Investor. If you haven't already, talk to a mortgage professional, talk to your financial professional, or if you need a referral there, I can help you as well. And let's get together. As I said, I love helping people with this kind of stuff. It's really a passion for me, and I do free consultations. So I'd love to do a Zoom call, or even grab a coffee, whatever makes sense for you. And in fact, let me go as far as saying, if we do a consultation, I will actually buy you this book, The Millionaire Real Estate Investor. That'll be my gift to you just for spending the time, because I just think it's so important. These are tried and true systems. And again, the more people who start investing today, the better off everyone's family and communities in the future. So let's get together. All right, so any questions for me, you can either take yourself off mute or put it in the chat. And Yvonne asked, so since housing prices tend, are you to the suburbs, central or western Mass, where they may get more for their money? How has the housing market in the Metro Boston area been impacted by this pandemic era? Okay. Right. And the more urban areas to a little bit of a hit, definitely, talking about Boston, Cambridge. I think it's subsided a little. I would say right now, the suburbs are definitely kind of where it's at for the time being, and only time will tell if that trend continues. I know even, New Hampshire and Maine have seen a lot of people coming from the cities, Boston and New York. And with people working remotely, I've seen clients moving, back to where families are from, and, or just where kind of it speeded up their timeline. If they wanted to move somewhere else and raise a family somewhere else, they're saying, well, why not? We're working remotely, why wait? And so I think this is definitely a trend, and it will probably continue to some extent. Especially, because I think a lot of companies are allowing hybrid schedules. So the commute is great. Yay. How to reach me. So here is my contact information. You can reach me by phone or email. Like I said, let's schedule a one-to-one and discuss your goals and see what I can do to help, if it's resources, or even if you're investing in another area. I have an entire agent network across the country, so I can hook you up with excellent agents wherever you're thinking of investing. I also have a Facebook group, which is called Ready, Set, Invest, and I invite you to join there. It's open to all of you, and there are lots of resources and guides on there too. And occasionally we do presentations, like live Facebook Live presentations and networking things on there. So I'd love to see you there as well. I'll also send you an email with a link to the recording of this presentation and invite you to schedule a time to meet, as well as sign up for future webinars that I have around real estate investing. So stay in touch. Let me know how I can help. Let me know what resources you need in the next step of your journey. And definitely do one thing today to take action toward your goals. Maybe an hour or half hour in your calendar. Visit what they really are and make them specific and measurable. Put it in your calendar today and make sure that you stick to it. If it's not in your calendar, it doesn't exist. So again, one thing, action, because that's where most people fall down. They learn and then they don't apply. So make sure you do that. And if I can help, please reach out. All right. So I really appreciate your time. Hope to talk to you soon, and have a great day and a great rest of your week. Bye, guys.
See ya.
See ya. Thanks, guys.